Hi there, everyone. Thanks for listening. We have a great conversation for you today. So good, in fact, that we've divided it into 2 episodes. In this conversation, Philip Bohai, VP of Compliance Education, chats with Dr. Adam Gailey, Principal in the Financial Economics Practice at Charles Rivers Associates. Adam has worked on numerous DOJ and CFPB investigations, class action lawsuits, and regulatory compliance cases. His cases typically involve providing statistical and economic analyses of large amounts of data focusing on issues related to the use of overdraft protection, indirect auto finance, redlining, and fair lending, which is the topic of our conversation today. In this first episode, Philip and Adam discuss getting your fair lending house in order and look carefully at questions surrounding things you can control, like underwriting, buy rate setting, and servicing. The second episode, coming next week, will delve into what you can't control and what you should expect next. Now, I'll turn it over to Philip and Adam.
Well, hi, everyone. This is Philip Bohai from APSA, and I'm here with Adam Gailey from Charles River Associates. We're going to talk a little bit about fair lending today, maybe tomorrow, maybe a day after that. Who knows? Because there's so much to discuss. But Adam, would you please just tell us a little bit about what you do and what you're going to be talking about with us today?
Sure. I'm Adam Gailey. I'm a principal in our financial economics practice at Charles River Associates, and I'm a fair lending economist. I've been working on auto fair lending issues for more than 10 years now, helping finance companies assess their fair lending risk.
Yeah, so let's kind of talk today about what companies should be doing as they get ready for scrutiny in terms of fair lending. And that scrutiny can come from lots of places, right? It comes from the government, it comes from markets, it comes from everywhere.
Yeah, that's right. Yeah, and even different levels of government. So the scrutiny may come from the CFPB. It may come from state AG offices. It may come from public service, advocacy groups.
Yeah, and I think that among all the different types of compliance risks that companies are concerned about, fair lending seems to me to be the one with one of the highest degrees of reputation risk. No one wants to be branded as a company that discriminates against customers, right? So maybe there's some other things that are elevated as well, but this one to me seems to be the most. And because, of course, fair lending, we're talking about discrimination based on things like race, gender, age, other kind of personal characteristics. Those things are so sensitive. So I think that's one of the good reasons why people are monitoring this risk at their companies.
Absolutely. And one of the key things as we think about all of these fair lending risks is around consistency. Are consumers who are from various groups treated the same?
Right.
And that can take the form of beneficial, challenges can arise from either beneficial treatment of some group or from making access harder to another group. So when you think about risk, you want to think about both sides of that.
Yeah, that's interesting. So in other words, you don't get bonus points for saying we treat all our customers pretty well, but there's a group we treat extra well. Right. That's not going to help you necessarily.
That is not going to help. And we see there are lots of different flavors of that across the various stages of the loan life cycle.
Right. And I think one thing, let's just establish at the very beginning. I think a lot of people have an idea that fair lending is about the decision to grant credit or not, but it's really everything, right? From application and in some contexts, pre-application, all the way through, let's say there's an approval, then the entire life cycle of the loan being serviced and then hopefully paid off on time, or maybe into some sort of default process. But these considerations last the entire time, correct?
That's absolutely right. Yeah, and they can even go before the application, so marketing and sort of concerns about discouragement from different areas.
Yeah. So in terms of, so let's say I'm a lender and I want to be sure that I'm paying attention to these issues. Where should we start? Where would you recommend I start to build some processes and systems and some people skills to get this stuff right?
Yeah, so I think the first place to think about is basically assess your process, right? Like
Yep.
what does that life cycle look like for you as an institution, and where is there human judgment?
Yeah.
And that's gonna and the place where there's more human judgment that affects consumers are the areas where you are likely to have higher risk
Yeah.
starting off.
And I think, but it's an interesting irony though, because even when you eliminate all human judgment, you can still be in a situation where you've had a disparate impact, if not a disparate treatment. Should we talk about that real quick?
Sure, yeah,
Just what those
and
are.
we'll yeah, so disparate impact is where you have what appears to be sort of a facially neutral policy, right? Um, like you've got a model score, right? Everyone scored the same. If they come in the same, they're gonna get the same score. It's exactly the same.
Yeah.
But in that score or in that policy, there's a feature or a threshold or something that acts different um, it creates differences across demographic groups
So in terms of the results or the
in
outcome.
terms of the results
Yeah.
in terms of the outcomes. So like let's say you had a minimum income threshold,
Yeah.
right, or something like that, and that given the demographics of our country, that is likely to create differences across demographic groups.
Yep.
And then the question becomes, and so that create differences in outcomes. Everyone's still being treated the same. Now the question is that really justified? Can you justify that income requirement?
Yeah. So I'll just share another one that I like a lot. I think it's a good example. If you're if you're a lender and you establish a minimum loan size for secured loans. So a minimum loan size on its face it's very neutral. Doesn't have anything to do with age, doesn't have anything to do with gender or race or any of those things. But because property values in America are not evenly distributed, in other words, there's not an even distribution of properties among people based on age, gender, race, all those things. If you establish a minimum loan threshold, then people without property to provide collateral at that level are excluded. And those excluded people may be correlated with some protected classes. So race, gender, whatever. So I just think that's another example to think about because at first blush, if I'm a mortgage lender, just use mortgages as an example. If I say, well, I really don't want to make any mortgage loans for less than $50,000, there's a kind of a reason for that. Maybe it's a lot of time and processing. I'm just not going to make that much money doing them. It's not worth my time. But in areas where minority people have properties that are significantly less in value, then they're going to be excluded at a greater rate than the general population. So anyway, just like thinking through those examples, because I think a lot of them do sound very neutral, but the effects can be devastating in terms of what you're expecting to find when you look at your portfolio. And so I think the other interesting aspect, I always think that fair lending is kind of it's looking at your portfolio from an external viewpoint to correlate your attributes of your portfolio with attributes of the population and to see if there's any outliers.
That's right. Yeah, and your example of the minimum loan amount, sort of that comes into this sort of what I think of as the first key area of that most places have discretion, which is in underwriting.
Yeah.
And sort of the decision, am I going to buy this contract or make this loan at the terms that were requested by the dealership? And there's a pretty common process at financial institutions is you get the details from the dealership, you pull the credit bureau from the repositories, some analyst looks at it and sort of thinks through the risks associated with the history of that this person has had and makes a decision, right? Either they say, yep, this is good, we can buy this contract. They might say, you know what, we need to counter this for a lower term or a lower loan amount. Or they may say, you know what, there's no way that this can get approved anywhere close to the way it was asked for.
Yeah, and I think a lot of times, even to take it one step up from that, I think a lot of times institutions in the auto finance space, in particular, they have a kind of an eligibility box, right? That a lot of the applications just get auto decision yes, and so the amount of scrutiny we're talking about is for that kind of business that runs it in that manner. That type of scrutiny is reserved for maybe a smaller percentage of all the applications coming in. So a lot of applications are going to come in within a framework of eligibility with regard to income, assets, credit, collateral, et cetera. They just get automatically approved. And so that scrutiny we're talking about, you've already done a selection in effect.
That's right. Yeah, and as long as those auto approvals don't get, there's no chance for them to then be turned into a denial because there's still a human overlay on top of it.
Right.
Then you're right. Then that when we're once you've sort of assessed those auto approval decision rules and made sure that you are comfortable with those from a disparate impact perspective, then you're right. Then the risk around underwriting is focused on this group that's going to get looked at by humans and analyzed subjective, but potentially objectively, but by humans who might be two different credit analysts may look at the same bureau history and think differently about what that risk means.
Yeah, and unfortunately, people have bad days. I have grumpy days. I'm sure you do too, maybe. So, I think that's one of the challenges. And I think from a compliance perspective, one thing that I've always been curious about is the benefits of removing human discretion as much as possible to make things into kind of binary yes/no decisions, so that they are that question of discretion is removed from them. But I think the challenge there is a couple things. First of all, I've had people tell me that they prefer human discretion for different reasons, and I can't really articulate what those reasons are because someone was telling me that. I wasn't telling them. But the other part, though, I think nowadays, as we're using more and more systems, more and more things like machine learning and AI, it becomes more difficult for business leaders and compliance folks to explain to regulators or to their peers or their boards how the decisions are made. And so when you build a complicated system to make decisions, the amount of documentation necessary to explain that to a regulator or a litigant, God forbid, it gets really challenging. I think that's something people have to keep in mind. It's great to have systems that do a lot of work, but someone's going to ask you to explain how those decisions get made. And if your people, they don't ask machines to explain yet. They still ask people to explain. So maybe we'll get there. But so go ahead.
It's a great point because anytime you build a model, there's a whole bunch of requirements you need to put in to be able to explain its decisions. But one of the challenges that I think a lot of people face is even explaining decisions that people make, right? If your data systems aren't, if your analysts are doing a full read of the credit bureau, right? And that, and so auto delinquencies are weighted differently from your analyst perspective than mortgage delinquencies or other forms of or unsecured credit, for example. Then if your systems aren't tracking those different data points, right, separately, then you have, even in explaining the human judgment component, you have the same problem. How do I explain that that happened if I can't pull the data necessary to do it?
Right. I think it becomes it's very difficult to both make decisions and document the ingredients of those decisions in real time, right? And I think one of the benefits of automation in business processes is the ability to make changes quickly. So if when a model and I use the term loosely because I don't think I really understand what a model is, but when your system makes a decision to change how it weighs different factors. So you give the example of we think default in mortgage is less or more significant than default on credit card for purposes of approving an auto loan. From time to time, the system will change its mind about that based on outcomes, and it will change, and then all of a sudden it will start processing in a different manner, and hopefully people or different systems have captured that the change occurred, so that you can explain later on. On June 15th, we decided to change the weighting that we gave these factors, and as of that date, we started processing in this manner, and that's what we did and why. So unfortunately it's challenging to do that in real time, but it's kind of necessary if you're going to make dynamic changes.
It's absolutely necessary from if you're using models or decision rules, etc., to just make sure you have the justification for those rules well in place.
Right. We started off talking a little bit about processes and policies, and so let's get back to that for a second, because I think that it's very difficult to do anything with your business, whether it's put in a new system or automate a process or anything, if you don't have a firm understanding of what those policies are. So let's kind of talk a little bit, if we could, about where you'd focus your attention. If you're looking at your policies from a fair lending perspective, because we've already been all over the place talking about governance and change management and everything else. But just to focus on fair lending for a minute, where should we start to focus on a review of our policies for fair lending?
Yeah, so I would start with a review of any of the things where there's discretion around, and whether or not those areas of discretion have definitions that can be interpreted consistently across people. So I'll give you an example. It's not uncommon for institutions to treat thin files differently than people with thick credit scores. But if you've got two different analysts who are consistent within themselves but are different across people about what is a thin file, right? What is a thin file for this product? And that's an area where you can improve consistency and sort of have a better, tighter definition. Now, you may still want to have some leeway in that, but you can make a tighter definition, and that's going to reduce your fair lending risk, because you're going to not be treating one group as thin from when they come into credit analyst A, and not thin when they come to analyst B.
Right. And then and managing those definitions has got to be somewhat challenging, because someone or a group of people needs to be aware of what are the characteristics of the applications we're getting these days. Now, if you tell me to define a thin file, I could only define it by reference to what it is not. And that's not a great definition. And so I think it calls for a good, close integration between the people who are doing the function. In this case, we're talking about underwriting, and the people who are making policy decisions. And that maybe that those are some folks who are senior in underwriting, or maybe it's in an audit capacity or a compliance capacity or wherever. And it probably, all this stuff at some point should percolate pretty senior in your organization, because at some point you're talking about these are decisions that are going to affect your credit risk. And so I guess as I talk it through, that's kind of, I guess, where it ends up, is some type of risk decision about how to go.
That's right. One of the things that can be helpful, and is we're doing underwriting analysis for people, and we're taking it from a fair lending lens. And part of that process may involve having credit analysts or people who do quality control on their credit analysts looking at matched pairs. So looking at approved non-Hispanic white consumers and denied minorities, or vice versa. And what you will often find, and while we're worried about that from a fair lending perspective, there are also sort of business lessons that can be learned.
Right.
Like, why did we approve this person? Was that the right decision? Do we have a policy that we need to firm up that says this, to avoid taking on risk we didn't want to take on, or conversely, to say, actually this person could have been approved. So it can be both. The sort of trying to these fair lending reviews can have, in addition to addressing fair lending risk and making that better going forward, there can be real gains to the business from a risk perspective from these reviews that can drive additional consistency.
Yeah. No, and I think that all makes perfect sense. I think I'm still thinking about leaving aside for now, because I think we'll talk about it later, what one can do to scrutinize or examine the characteristics of your business as it runs. I'm still kind of thinking about building it, right? So in terms of building the policies and the practices and the systems that'll keep me out of the most amount of trouble. Let's talk a little bit about some of the, I know you focus a lot of your time on, and maybe all of it, on auto finance issues. Is that right?
It's not all my time, but it is a lot of my time.
And so I think that auto finance has a lot of interesting characteristics that we should maybe talk about real quick, because I think they present interesting fair lending problems. So we talked a little bit about how credit applications come in, how they are assessed, and maybe counters need to be done. Let's talk about some of those types of things that are neither a direct approval nor a complete denial. So those middle territories where things happen. So I know we talked a little bit about adjustments to rates and so forth, and counter offers, stipulations, et cetera. So can you talk a little bit about how those work?
Yeah, so counter offers are these situations where you can't really approve the application as submitted, but you're going to request it to be different. And there are lots of ways to treat those from a fairness perspective. My view is generally that the first question we should ask is, as people walk through the door, do we treat them all the same?
Right.
So you have people who are going to come in the door who you countered, and then the consumer says, yeah, that's great, I'll take it. Right, and the contract gets made. But at least one perspective is to still think of that person as a denial, but as they were from a fairness perspective, but as the sort of application that they wouldn't that you said the loan amount is too high on.
Yeah.
And another sort of area where it's like a counter. But it's not really changing the terms of the loan or stipulations. So this is examples where you might have someone come in and the loan amount is fine, the term is fine, but you're going to ask for additional income verification.
Okay.
That you might not always ask for. And so there can be a fairness challenge if the decision about whether or not to ask for things like income verification are done inconsistently across groups.
That's interesting, and that raises a point for me. So that example, where let's say a finance company has an uneven process of requesting additional income verification, and so let's assume that happens. Asking for additional income verification doesn't seem like it's not zero harm to the customer, because it's additional friction and maybe a delay, but it's not the same as a denial or an increased rate that has a very concrete economic harm. So that's a good example to talk about, because I think from the fair lending context, we're not just looking for economic harms. It's the discrimination, whether it's overt and intentional or unintentional, is the harm.
Yeah, in the indirect space, given there are a fair number of finance companies that don't require income verification a lot, and so requiring income verification, there are a couple of different groups that don't like that. When your relationship with the dealers don't like it because it's adding extra friction. But the dealership is likely just going to send the contract to someone else.
Right. No, but I think it is interesting to think about that. I'm glad we kind of landed on that example, because one of the questions about back in my mind was, if you're concerned about fair lending scrutiny and fair lending risk, you should think about things that are not just economic. So that's, I think, a good example of that in terms of verification.
And then the other challenge there with stipulations, with counteroffers, is what data do your systems track?
Yeah.
Right. Lots of finance companies or banks, especially in indirect auto, they may not keep around the information that was submitted by the dealer. Right. You counter it. Well, the old one's gone. There wasn't necessarily a business purpose to keeping around that old information, and so all you have left is the countered information. or especially if you say then the loan then becomes a contract.
Right.
What data is available to assess that initial question? Did we counter? Did we step? What were the terms before we did that? It's important to gain the fair lending analysis right.
Yeah, and so that becomes a data retention kind of idea about what data you're going to keep for how long.
Exactly.
Yeah. Okay, and then let's talk a little bit about the economics in indirect auto. So one of the things I think indirect auto is so unique in that there's so much discretion in pricing, right? So if you're going to finance a car, the car likely has a discretionary price. I mean, Saturn's gone now, but I guess some dealers are still just doing one pricing. But your car may be negotiated. Any voluntary protection products, you can negotiate the prices on those, and then the customer can negotiate the interest rate. And so I think that all those things make fair lending questions difficult for finance companies. So let's get into those for a minute.
Yeah, and when I think about pricing on the interest rate, there's sort of two components.
Mm-hmm.
There's this is the same way that the agencies think about this. You've got what the agencies would think of as the rate that you control,
Yeah.
which is sort of your risk-based rate, oftentimes referred to as the buy rate.
Yeah.
And then there's the rate that the consumer agrees to,
Mm-hmm.
the interest rate, and the gap is dealer reserve is usually how you are comping the dealer, right?
Yep.
So if there's a higher gap, the dealership is getting more money,
Right?
And different there are different issues with each of those two prices.
Mm-hmm.
In buy rate, the agencies understand that all the things that go into your pricing grids, and if you got different tiers, you've got different buy rates for how old the vehicle is, et cetera, et cetera.
Yep.
And they understand that that's all relevant to the question as to what the buy rate should be.
Yeah, and if you're a captive, you may have subvention. So that's another thing that you get to play with if you're a captive.
Yeah, absolutely. Yeah, and the regulators understand that that there are all these different policies that can set in. But one of the things that the regulators also see is that there are plenty of finance institutions that have no discretion in the setting of the buy rate at all. So
Mm-hmm.
the buy rate, it's person A comes in, given their sort of FICO score or whatever scoring metric you're using, and term and et cetera, and whatever the various factors are.
Yep.
Any two people who come in the same are going to get the exact same buy rate.
Yeah.
There are other institutions where that's not the case.
Okay.
Right? Where the buy rate is there's still sort of a qualitative assessment of the consumer's risk, and you might, as a financial institution, bump someone from one tier to another because of different features, or you might just sort of give a discount to someone. And if you're in the boat where there's a bunch of judgment around where your buy rates are,
mm-hmm.
That's an area that you want to focus on, because the regulators sort of view that as you have control over this. Is their view?
Sure.
You have control over this, and there are models out there
mm-hmm.
that don't have just this discretionary component to it.
Yeah.
And so, and the discretionary component is what can lead to differences in pricing across demographic groups.
Yeah, but I think so. Yeah, that is interesting. I think I had in my mind, I thought more companies were in that former group where the buy rate's the buy rate and it's less dynamic. But it's very clear in your example how having a flexible, dynamic buy rate that corresponds to economic factors or the time of the month. I don't know to what extent the finance companies do that, but I know dealers are motivated to sell at month end. So you have all those things, and I would agree with regulators, I guess, that buy rate is somewhat more in the control of the finance company. But when you buy the contracts, you're buying a variety of different spreads from your buy rate to the rate on the paper. And so that's where I think the fair lending challenge becomes really acute, because the interest rate's so prominent on the contract and the dealer box, and it is something that customers are encouraged to comparison shop. I would go so far as to say the regulators beg consumers to comparison shop for interest rate. So it's a prominent term. It's generally understood what it is. And if you have a group of customers, you bought contracts from, let's say one dealer is somewhat more aggressive on pricing and tries to maximize the permitted amount of dealer reserve. And you have another dealer that, for whatever reason, is just kind of like, oh, we got what we got. They're kind of operating a volume shop kind of environment. Then in your portfolio, you have all these variations. And I guess the fair lending question is, okay, do these correlate to anything we're concerned about in terms of gender, race, source of income, age, all the eco and protected class things?
That's right, and that is absolutely a concern. And you've seen settlements between the CFPB and state AG's offices over this issue, and regulators will generally look at your portfolio as a whole. Not accounting for the fact that you have these different strategies at the dealerships. And the generally the feature or factor that they're willing to consider is what your cap is on the dealer reserve. So if you've got a cap that let's say it's 200 basis points on some set of contracts, maybe your shorter term contracts, and a long like say a 175 or 150 bip cap on your longer term contracts, they'll allow you to consider that as an explanation for why your dealer reserves might be different, but generally nothing else. Even though there may be non-discriminatory reasons for why two different consumers have different dealer reserves, but because you may not have a policy around it, you may not have you may not know what the dealership's policy was around why they charge dealer reserve of different amounts on different people.
Well, and that's the thing too. I mean, just in fairness to dealers, I would imagine the rationale is because they can, right? And and I think that it's so frustrating, I think, from a finance company perspective, because customers at auto dealers, they come in with varying levels of preparation, varying levels of homework done, and with counter offers. And Dan and I did a podcast for AFSA a couple months ago, maybe a year ago now. Time flies at AFSA, of course. We did a podcast talking about how to prepare to go to the dealership and all the things you do. And so I know how to do it. I'm pretty good at negotiating and come prepared, but other customers are not. And that's their choice, right? There's no obligation that you can impose on customers to comparison shop a certain way. But the finance company, you're going to buy the contract and you're going to get what you get. And even assuming it's completely consistent with the dealer reserve policies and your internal policies, you can still find, when you do a fair lending review, that you have kind of outliers, even within those limits.
That's right. Yeah, that you may find that you've got differences in the average dealer reserves across demographic groups, even if you have caps, and a number of the regulators will hold you to those. And if they see those kinds of disparities, they may expect some flavor of remediation.
Right. Oh, and it's just it is frustrating, in as much as a lot of these things can be explained by the manner in which the market works, with the discretionary pricing for interest, and the fact that some customers are hard negotiators. And I don't mean hard, difficult. I mean strong, effective negotiators, and some customers just aren't. So
yeah. As I put my regular hat on, I think it's you can speculate that that's what's driving the price differences,
right?
But unless you can show it, it is hard to it's hard for them to accept the justification.
Right. No, that's an excellent point. So it goes back to you're going to have to prove whatever story it is you're going to tell when you are. And I don't mean story in terms of fiction. Well, I mean, you're going to have to explain your decision making and things, sometimes on an account by account basis, if you're subject to that kind of scrutiny or litigation potentially.
Yeah. One of the challenges that finance companies face in this exact area is we're talking about looking at your portfolio as a whole, where you've got you've got many contracts brought to you from across lots of different dealerships.
Yeah.
People will also focus on the dealer level, right? So
Yeah.
can I find some dealerships that are driving my results as a whole? And one of the challenges that that you often face is that in most portfolios, no particular dealer is a large portion of your portfolio. Right? You may be working with lots and lots and lots of dealers,
Right.
getting a few contracts a month from each of them, and so you may try to go, oh, let's go try and find the dealerships where this is causing, where a problem is coming from, and
Yep.
what you'll find more often than not is that it's not that your portfolio results are not being driven by some particular dealer that you can go and cut off or chastise or however you want to manage that relationship. That it's actually the aggregation across all these dealerships that are causing the problems. And one of the things we often will do for people is take some period of time. Take the set of dealerships that have disparities on their own in that time, right? Which you might think of like these might be our sort of ones we want to go do some fair lending review with, et cetera. Take them out of the portfolio and rerun the portfolio analysis. And most times you don't see much of a change to the portfolio. So I think it is good and important to do dealer level monitoring to sort of identify potential risks at dealerships, so you can sort of talk to them about their responsibilities. But it is not typically a good solution for the portfolio level results.
Well, then that's just another issue as well. I think that historically, auto finance companies in the indirect space have tried to design their systems in a manner that prevented them from knowing different pertinent characteristics of the consumers. Right? They don't want to know. They don't want to know the race or gender or age of the consumer. I mean, age, as long as you're over 18 and you have capacity to contract. But other than that, and I've heard folks from finance companies say in terms of these fair lending questions, like, well, we've designed our systems in such a way that we don't really know what the customer characteristics are when we approve or decline or counter or service. And so that's an interesting piece. And I think that one way to maybe assess fair lending risk is to try to develop some information regarding the customers of your dealers and the characteristics of the customers. But there's that tension again where it's like, well, do you want to know and have records in your system somewhere that your dealers maybe have a clientele that tips in one direction in terms of race and ethnicity or age or any of the other classes? That seems to me like maybe it would be good to know that because you could assess your fair lending risk maybe and concentrate your efforts, but it might be also be negative to know that because you maybe prefer not to know.
Well, I think the other challenge is that in any given dealership, you're only seeing the paper if you're an indirect auto.
That comes to you.
You're only seeing the paper that you buy from them.
Right.
And that might be a really small share of their paper. So even if you saw sort of disparities in what you purchase from them, that doesn't mean that the dealership as a whole has disparities. And so, which I think is another challenging dynamic.
Yeah, and I know that some of our members are specialized in super high credit score customers, and some of our members specialize in credit for lower credit score folks. And so that gets into a whole other kind of realm where your portfolio is not going to be representative because you've chosen for business reasons to specialize in one segment of the market. And so I think your characteristics there can look different than everyone else's. And you have to be able to justify and explain why the characteristics of your portfolio are what they are when they're looked at.
Yeah. Why did you make that decision? And that also gets back to some of those questions about disparate impact on sort of where's the box that I'm going to operate in.
Yeah. Let's talk a little bit about servicing. So we've been talking a lot about originations and kind of setting up our fair lending processes. In terms of servicing, what are the kinds of things we need to look out for?
Yeah, the key things on the servicing are around, again, as if you're going to hear me say this a bunch of times, but what part of that process has a discretionary component to it? Do if you have someone who's fallen behind on their payments, how does that dealt with? Is it is it rules based? You follow the same, at 60 days you do this, at 90 days you do this, 120, etc. At this day you start this process. If that's a rules based system that's always the same and you don't ever adjust from it on a discretionary basis, then you want to look at the rules and make sure that they make sense so that you can justify them. But if you have a system where you set that up, but if the customer comes in and calls and they you feel good about them, or whatever that means, that you delay the repo by a month or whatever, right? Whatever the the policy may be, or it's not necessarily in policy, whatever the sort of action may be, that's where you can end up with risk. And sort of like I said at the beginning, the risk isn't just sort of accelerating people faster, but it can also be decelerating a group of consumers slower, so that that group that you're decelerating is more in a sort of that breaks unevenly across demographic groups, that can create a fairness risk.
Yeah, and that's always so ironic, because I think people generally like to help one another, and I think that the argument for consistency, and for me, I mean, again, I've never run a lending business, although I've worked in them. To me, the benefits of having firm, inflexible rules that apply to everyone seem to me to outweigh the benefits of the human touch. But I understand I'm maybe in the minority on that.
Yeah, not every institution runs the same way.
Yes, of course.
And there are definitely different philosophies around it. But even if if what you're finding on any of these dimensions where you've set up a rule, and what you're finding is your analysts are constantly sort of bumping up against that rule and asking for exceptions and calling into anything, it suggests you maybe need to adjust the rule.
Right.
Right. That you thought it should be this way, but actually what we need to do is adjust it some way, and then you adjust it to the new rule, and then you apply that new rule consistently.
Yeah, and that's interesting. Or maybe you would determine that your culture isn't really good with rules, and you need to assess why that is and how to make it better. Because rules are helpful to guide behavior and drive consistency for folks and make their jobs easier. And so if you find that, I know a lot of companies prize innovation, right? I've worked at a company where we talked a lot about innovation. It was really big. And what we would learn when we were doing work, the things from a compliance perspective, is that sometimes someone would innovate the compliance right out of a program. And so that's a funny double-edged sword. It's like, we encourage people to think outside the box and come up with solutions. Like, yeah, but you can't implement them all without checking. There's some certain things you have to do. So that always makes me chuckle. Well, I think I know we have a lot more to talk about that we're going to do in another episode. So what else should we kind of close off here? And in all our wide-ranging discussion, Adam, what did I take us away from that we really wanted to hit?
No, I think that the key takeaway, if there's like one is, and if you're looking at your program and you want to look at it from the beginning to end, is to look for areas where there are discretionary actions being taken, and understand how consistent are those. Is that discretion applied, and are there ways to make that more consistent?
Yeah. No, thank you. And I think what we'll talk about in our next episode is you've done all those things. You've eliminated the maximum amount of discretion. And now you're looking at your portfolio with a fresh set of eyes, and all hell has broken loose. Because despite all your best efforts, maybe you have something that's an outlier. And what are we going to do about that?
AFSA hopes you've enjoyed this edition of the Extra Credit Podcast. Don't forget to follow AFSA on Twitter at AFSA_DC and on LinkedIn. Just search for the American Financial Services Association. You can follow AFSA's SGA team on Twitter at AFSA_SGA. The blog at afsaonline.org is also a great resource for the most up-to-date news. If you've got questions or if you'd like to suggest a guest, please shoot us an email at communications@afsamail.org or tweet at us. Join us next time for more Extra Credit. Thanks for listening.